A strong sell-off in banking stocks yesterday. It appears the market's still digesting that surprise 50 basis point cut by the MPC earlier in the week. What are your thoughts on why investors have been reacting badly to this news when it comes to those banking stocks?
Yeah, you're right, Samantha. Investors reacting strongly to the MPC decision. If we recall, the MPC hiked the benchmark rate by 50 bips and then raised the cash reserve requirement for banks from 2% to about 4%. Now, what we saw was heavy sell down in lots of the banking stocks. Some of the top tier banks, the likes of UBA, lost full 5%. And you begin to understand when you analyze the situation very well. For us, we think the MPC decision would lead to the following things. One, it's going to increase the cost of funding for banks, particularly for banks whose deposit base is more skewed towards wholesale rather than current and retail accounts.
Which banks are those, Pabina?
From our findings, we are looking at banks like FCMB, maybe a bank like Stanbic. They have close to 50% of their deposit funding from wholesale. So we think they will be most affected by this decision. If you look at the other side of it, we think banks would have to reprice their loans. Particularly, if you look at it from the retail end, that might be a little bit possible. But then if you're looking at those that lend to AAA rated borrowers, many of the large cap banks are in that category. The ability to transfer whatever increases has come in the interest rate environment will be quite difficult because of the numerous funding options that are available to that category of borrowers.
Now, looking at your forecast for credit growth this year, you say that you're expecting around 10 to 15% year-on-year growth. This is largely going to be driven by corporate demand with increased M&A activity, need for funding, infrastructure finance coming through. Will banks be able to meet the demand from businesses, given the fact that we had the cash reserve requirement being increased by 200 basis points by the governor?
Well, we could look at a couple of things. From our calculations, the impact of the cash reserve requirement hike, it's probably about 180 plus billion of potential assets that could be created in terms of loans. Now, if you also look at it, average loan to deposit ratio in the industry is somewhere around 80%. So we think there is still room to achieve our desired loan growth.
You're still bullish, though, on banks in your coverage. If I see from your sector report, you remain bullish on Zenith, First Bank and Skybank at their current prices, saying that you see they're fundamentally undervalued at this stage? Yes,
they are. We like each of these banks because we think the market is yet to fully price in the earnings potential we see in them. If you look at it in terms of trading multiples, they are still relatively attractive. If I would average those three banks, we'll probably be looking at something around 1.2 times price to book. So pretty attractive when you compare to the likes of GTB that is trading at over two times book value. So with strong earnings, we like the business models of this bank, and we think they can deliver the earnings to justify our target prices.
Now, just moving on, Jonathan, good luck, Jonathan, coming out yesterday saying that he's cut the Nigerian budget for 2011 from 4.9 trillion naira to 4.4 trillion naira. Do you think that this 10% cut is substantial enough, given the fact that the finance minister has called for a period of financial consolidation and prudence?
Very interesting development for us. We like the direction in which the fiscal side of the economy has just taken. If you recall, there were lots of calls some months ago when the National Assembly raised the earlier budget the president proposed from 4.2 to 4.9 trillion. So following that, we saw that there are lots of pressures going to come out of the economy as a result of that hike, inflationary pressures, pressures to fund the large deficits of about 1.9 trillion. You know, so in all, we think it's a positive development. Some interesting lines for us. Recurrent expenditure was down. Capital budget was down, but not as much as we had in the recurrent. If you look at them in percentage terms, recurrent budget was down to 68% from 69% of the total budget.